Good afternoon, everyone, and thank you for joining us for the CAISO WEC 2018 Fall Outlook, SoCal Gas, and Power Volatility. When will it stop? We're going to help you understand how to navigate the CAISO market this fall. I'll be leading the presentation here, Ross Fessenden, CAISO WEC Power Analyst, and I'll be joined by my colleague Eldon Lopes. He'll be covering the CAISO WEC demand portion of the presentation. Just a reminder, feel free to submit a question at any time that you do have it. The slides and recordings will be sent out tomorrow. And we are going to have a survey at the end, so we'd really appreciate any feedback you have to help spur future growth and content on webinars to come. Quick rundown on what we're going to be covering today. Review of summer 2018, record warmth, and the weather factors that went into that, as well as how we did on our projections from the summer outlook. We'll take a look at fall demand, including temperature and precipitation forecasts, as well as ENSO expectations and a forecast for that as well. We'll delve into SoCal gas dynamics, touching on prices as well as storage withdrawals. We'll update where pipeline maintenance stands and expectations heading into the fall, as well as a quick rundown on the state of SoCal gas storage. We'll then finish off with pricing and congestion, covering generation changes, as well as both north-south and LA Basin congestion expectations. And then that will lead us into the review and forecast of congestion and pricing for the fall. And we'll finish with a quick poll and time for questions that you may have. So taking a look here at summer 2018, we did see CAISO summer load on a cumulative level come within 1% of our expectations. So we're giving ourselves a check mark there. Generation, a little mixed here. We did see the forecasted tight thermal stack that we had covered in the summer outlook, but hydro persisted at above expectations, primarily through the end of the summer, more so as we moved through the summer. From a transmission and congestion standpoint, NP did consistently see downside from various constraints, including Midway Vincent, Eagle Rock Gould, and Barvilla Park. Gas, check mark here as well. SoCal Citygate gas reached all-time highs. And then lastly, imports. We did see strong imports from the Northwest into CAISO, and this did contribute to higher mid-sea prices. And with that, I'll pass it off to Eldon, and he'll take you through the demand section.
Thanks, Ross. So taking a look at how we began summer, we began summer with a neutral El Nino, a neutral PNA, and a weak negative PDO. This resulted in high pressure in the North Pacific. We had cool sea surface temperatures, and the net result was that we had strong high pressure ridging throughout the West, but especially in southern WEC in the June to July period. We saw anomalously warm conditions, especially in July, where California was basically 5 degrees warmer than normal statewide, and is widely considered to be the hottest July in recorded history for the state of California. Taking a look at NorCal, we saw temperatures come in 2.4 degrees above expectations in June and 5.1 degrees above normal in July. And in SoCal, we saw temperatures come in 3.1 degrees above average in June and 4.7 degrees above average in July. Significantly, in NorCal, we saw the third warmest June to July period in recorded history, and in SoCal, we saw the second warmest June to July period in recorded history. So while there was significant heat on the precipitation side, wasn't really too exciting, pretty near normal. The West is typically very dry this time of year. Small positive anomaly in Arizona from some monsoonal rain, and more significantly, the coastal Northwest. So some below average precip, but like I said, nothing too significant in the June to July period in regards to precipitation. Taking a look at what transpired in August thus far, we have seen that really throughout the entire West, temperatures were either were basically 0 to 5 degrees above average, but most significantly, SoCal remains 3 to 5 degrees above average throughout August. The pattern did shift a bit. High pressure wasn't always concentrated in southern WEC. We saw it oscillate between the Pacific Northwest and kind of interior SoCal and Nevada. This kind of strange pattern allowed above normal warmth in the Pacific Northwest and in SoCal, but it allowed for onshore flow to keep temperatures more or less near normal in NorCal. And SoCal, in addition to the heat that we've seen this summer, has also been humid, and that's because with that area remaining under high pressure, we've been seeing rapidly warming sea surface temperatures. So the combination of the heat and humidity really drove interesting demand in SoCal this year. In terms of precipitation, it was a little bit more interesting this month, where some monsoonal precip really picked up in Arizona and Utah. So taking a look at what this translates to in terms of like demand numbers, we saw CAISO's peak come in a gig lower than it did last summer. Most of this was due to August ending on a cooler note at a time when we usually start seeing peak load. CAISO began to dive off, but it's still a respectable load number. I think most interestingly, we saw PG&E have a sub 20 gig peak, which is the lowest we've seen in recent years. And this occurred despite some pretty anomalously high temperatures. This was tied with predominantly in PG&E, since it's such a wide geographic area. You'd have the Central Valley get pretty hot and interior portions get hot, but the coast wouldn't, and vice versa. So you had this issue of not having the entire load zone being hot at the same time. And you also had continued growth in behind the meter, and also some pretty cool nights in coastal NorCal. All those helped erode demand despite average temperatures being anomalously warm. SCE correlated much better with the very high temperature anomalies. We saw our all-time peak load for the June, July, August period on July 6th of this year. So to continue on what this means for fall. So looking back at fall, we typically see demand peak in September. As we all know, September is more or less a continuation of summer in California. This year, our expectations are kind of like if load's going to peak, when load peaks in September, it's going to more likely be towards the middle or at the end of the month, as like initially given this cool August or the cool end of August. That looks like it's going to continue at least through the first week of September. But nonetheless, we're going to see high pressure ridging kind of shift more inland, and this is going to increase the threat of Santa Ana events, which could, under the right circumstances, drive some pretty high peak load. But basically with all that included, we're still expecting pretty decent demand peak with levels more or less similar to what we've seen in 2017. So taking a look at our fall forecast, we have strong high pressure focused over the interior Northwest, more over Idaho specifically, where we're seeing anomalies 2 to 3 degrees above normal, but the rest of the West being 1 to 2 degrees above normal. Precipitation-wise, we have a dry swath in NorCal and much of the interior West. This is being largely driven by a cool water in the North Pacific, warm water in the East Pacific, and a weak El Nino. And on the next slide, we can see, okay, there it is, our monthly breakdown of how we're expecting this to pan out. We're really expecting the strong high pressure that we have seen to really build into the interior Northwest in September. To take note, when you have high pressure in the interior Northwest like that, it's very favorable for Santa Ana events. So while peak load will be difficult to match what last year's was. So long as you can get that up and down the coast, it's a possibility. But nonetheless, those are kind of few and far between, and average temperature anomalies in California will remain 1 to 2 degrees above normal. And precip-wise, expect the Northwest to be drier than normal given high pressure is centered there. In October, we see high pressure weaken a bit, but basically the entire West remains above normal, 1 to 2 degrees above normal. And we're seeing a signal for a weak resumption of the monsoon, particularly around Nevada. I'll get into that when I discuss our analog years. And in November, we are seeing high pressure remain throughout the West and dry conditions for the most part, with the winter storm pattern allowing for some wet anomalies in the coastal Northwest. On the next slide, our principal driver is the weak El Nino, and confidence in this is very strong, both on models that are dynamical and those that are probabilistic. If anything, the risks are that it's drier in the Northwest and a little bit cooler and wetter in the Southwest, but this is correlating very well with our 2012 analog year, and some other years similar to this were 2008 through 2010. So in regards to renewables, this chart here is a chart of basically wind speeds at the height level of most wind farms, and the blues and the purples are below normal wind speeds, and the yellow and the reds are above normal wind speeds. And what we're seeing is we're slightly bearish for wind production because our analog years are showing slightly lower wind speeds in NP. Like, once again, this isn't the strongest signal in the world, but it should be slightly bearish, especially given that BPA and SP wind looks to be hovering near normal. And now discussing solar, this is much more interesting. So OLR is outgoing long wave radiation, which in English means heat from the ground. And satellites use this to measure cloud cover. Typically, when you have cloud cover, you'll have below normal OLR, which would translate to yellow and red anomalies. And when you have, maybe I got them mixed up. When you have above normal cloud cover, you have less heat coming from the ground. So that translates to the yellows and the reds. And then when you have below normal cloud cover, where there's like no clouds, you have more heat coming from the ground, you get those blues and purples. So what we're seeing is in the desert Southwest and in California, with our analog years, there's typically less normal cloud cover. So this will mean that we see stronger solar production, especially when you take into account continued build in solar. So now taking a look at kind of what's happened with the drought. Last year was pretty ideal for the West, given how there was a very wet winter, and more or less that allowed the West to remain mostly drought-free. But this year was the opposite, as we have seen high pressure dominate, less precipitation, and now we're starting to see in the Northwest and in California moderate to severe drought resume, and in the desert Southwest, despite some monsoonal precipitation, is still largely an extreme and exceptional drought. Expectations for the drought to develop are basically we agree with the CPC and seeing drought expand in the Northwest. Although we're more bullish on that, we're thinking that it's going to expand as well into Idaho and Montana. And then in California and the desert Southwest, we're seeing conditions deteriorate slightly, not too much. They're seeing some alleviation in the desert Southwest, but we're not thinking that. So with all that, I'm going to hand this back off to Ross, where he's going to discuss the crazy SoCal gas market.
Thank you, Eldon. Heading into some of the gas and pricing and demand data here. First, we'll take a look at the daily peak demand for SCE in the day-ahead cleared portion compared to on-peak average SP LMP prices. And what you'll see is periodic volatility from both demand and then obviously prices. And on the whole, summer volatility did not disappoint the expectations that we highlighted in our summer outlook. SoCal gas, as well as SP pricing, reached all-time highs since the market went nodal, with SCE gas peaking at $39.72 and SP day-ahead on-peak pricing, the on-peak, not the peak hour, averaging $377.32. SCE demand peaked pretty close to last year. It was within about 100 megawatts of last summer's peak, and that occurred on July 6th, as Eldon showed earlier. One thing of note is that while record temperatures were observed this summer, not just in SoCal but statewide, we didn't see demand reach quite the levels that last summer did, partially a product of what Eldon touched on earlier, that you didn't have coincident peaks between zones, as was the case last year in September 1st. CAISO, PG, SC, and San Diego all hit their peak load on the same day, which does not happen very frequently. Taking another look here at SCE demand, we're looking at total cumulative SCE summer demand over the last 4 years. And it's worth noting that 2018 isn't complete, as there are still a few days left in August, and it already has surpassed each of the last 3 years, with last year, worth noting, is a record year. This is especially significant when you take into context the BTM component, where 290 megawatts of added BTM capacity have been installed since last fall. So not only was last year a record warm year, but you've also seen since then 290 megawatts of BTM, which normally would be a drag on demand, but we still managed to see SCE demand peak higher than each of the last, or exceed each of the last 3 years in total. So this begs the question that with the ongoing pipeline constraints on the gas system and this high SCE demand, we were likely to have seen pretty significant withdrawals, is what one would expect. Well, that's not really the case. On the left, you'll see a chart that plots monthly withdrawals by year, dating back to 2012, and on the right, total summer withdrawals during June, July, and August. Total withdrawals are at their lowest levels since 2014, with only 10 total days of withdrawals occurring this summer, despite pretty intense SCE demand, as we've highlighted. It's also the first time since 2012 that the month of June did not have any days of withdrawals. Again, this despite SCE demand being at its highest summer levels in the last 5 years, summer electrical demand, that is. So the question remains, if SCE demand is not being met through SoCal withdrawals, what is serving this load? Well, the first plot shows Path 26 flows scheduled in the day ahead in the north-south direction, and it's pretty significant that Path 26 flows so far summer to date, again, a few days left here to tack onto this, are more than double any of the last 3 years on their own. So pretty significant increase there, indicating that more power from Northern California has flown into SoCal to meet that higher demand. Another factor is wind generation. As you can see in the plot on the right, showing cumulative wind generation in the months of June, July, and August over the last 5 years, this was the strongest total summer wind that we've seen in that period. And again, a few days left here to tack onto that total. Another factor, a little bit less so as build has slowed in recent years. We still saw more solar generation this summer than any before as a product of that increased capacity, albeit slower than recent years. Moving into current pipeline conditions on the gas system. L235-2 force majeure, that's one that we've been highlighting here for quite some time, going on almost a year now. Officially, the end date for that is to be determined. They have no end officially listed, and this maintenance and outage reduces capacity into SoCal by 270 MMCF per day. Another outage that we've talked quite a bit about, the L3000 remediation. This is slated to end in mid-September. So 2 points of note on this. That outage, the end date rather, has been extended multiple times, but it has not been extended since mid-April. So going on almost 5 months now that outage end date has stayed static. It still bears watching, but it seems a little bit more certain than at other times during the course of this remediation. Another point is that there is no available capacity as a result of this outage, unlike the force majeure, which is only reducing capacity in that region by 270. So with these outages in place, it's worth noting that price volatility will remain possible, especially during times of strong SoCal demand. So certainly a risk through mid-September, and it really bears watching to see if they extend this further, in which case the concern for that price volatility would continue through the fall as long as that outage is in play. Another factor to consider is Aliso Canyon and overall SoCal storage inventories. So taking a look at the state of SoCal storage and updating the Aliso Canyon situation. On the left, you'll notice a chart highlighting June, July, and August inventory levels in SoCal over the last 4 years, the last 4 summers. And you'll see that for 2018, we're at the highest summer inventory levels since the Aliso leak occurred in 2015. Despite that strong SCE demand that we've highlighted throughout the presentation, we saw inventories build in SoCal through summer, and partially a product of those past 26 flows, but also, again, the contributions from higher wind generation, as well as hydro persisting at stronger levels than forecast. On July 2nd, CPUC did announce an allowable increase in Aliso Canyon storage capacity from 24.6 BCF to 34 BCF. The net effect that this had was increasing total SoCal storage to 83 BCF. So at present, we sit around 72 BCF, meaning that some of the concerns as far as drawdowns on that storage inventory from earlier in the summer weren't quite as dire as some of the pictures painted. Looking at how injections have tracked through August, they are averaging about 270 MMCF per day. And in order to fill SoCal storage by the end of what's considered injection season, so the end of October, they would only need to inject about 197 MMCF per day. So given some of the low load that we're seeing here at the end of August, they've been able to increase those injections and seem much more likely to fill SoCal storage at some point this fall before the end of injection season. So now translating this into some gas expectations and thermal gen expectations. Looking at hydro specifically, we continue to see levels fall from the 2016-2017 record water year. And as a result, we expect fall hydro generation to decline and increase the burden on gas generation. Another contributing factor is weaker Northwest imports. We do anticipate that the low levels of BPA hydro generation, as well as climatologically weak BPA wind, will translate to lower Northwest imports this fall. Another factor is California fall demand. While it is still going to be warmer than normal, it is slated to be stronger year over year, weighted a little more heavily to the October-November period, where we're forecasting cooler conditions than October-November of 2017. Putting that all together, on the left, you'll see the cumulative fall thermal generation dating back the last 5 years, with 2018 being our estimate, coming in slightly above each of the past 2 years, last 2 falls. And so really just given this increased thermal generation, and again, the pipeline restrictions that we've highlighted, the L3000 and the L235 to force majeure, as long as those persist into the fall, be it September 16th or beyond, any period of strong SoCal demand is going to carry with it the risk for price volatility in both the gas and power sectors. Now we'll move into the pricing and congestion section. We'll start off with some generation changes. Ormond was slated to retire in October of 2018, and Elwood had been slated to retire January of 2019. Because of the need for these generators, it doesn't look like they are going to be retiring until 2020. So Ormond directly impacts this fall, and Elwood impacts calendar year 2019. Another generation change is the addition of about 100 megawatts of solar PV from the Antelope expansion, which is slated to come online September 2018. So really any day now we could be seeing that facility energized. Another point of note for the generation side, California Energy Commission did put out a monthly resource adequacy forecast, and it did exceed the WEC monthly peak for September by almost 1,300 megawatts, so higher than those resource adequacy estimates. So as a result, CAISO has declared what they deem a significant event, and as a result, will utilize the capacity procurement mechanism for September, and in this case, will be for about 1,430 megawatts of capacity. The last time we saw what was deemed a significant event was in 2012. Many of you may recall the unexpected shutdown of San Onofre generating stations 2 and 3. Looking at the CAISO resource adequacy versus the WEC forecast on the chart on the right, it also looks like capacity procurement mechanism may be necessary for both October and November. Rolling forward the 1434 that they procured in September to October would still leave an additional procurement of about 3.7 gigs for the month from October 1st to the end of the month. You'll also notice on the plot, on the chart at right rather, that the WEC forecast deviated from the resource adequacy number pretty significantly in the spring, but no significant event was declared, primarily as a result of the lower load levels in the spring, as well as much higher hydro in place. Taking a look now at some north-south congestion concerns, you'll notice again the average hourly Path 26 flows in the chart on the left in terms of megawatts. And again, it really stands out the difference between summer 2018 and any previous summer in the last 3 years. This translated to strong Midway-Vincent congestion and a large price gap between NP and with SP over NP. This congestion also was exacerbated by high load in the south, as indicated earlier in the presentation. We do expect this congestion to continue due to this gap that persists in gas prices between SoCal Citygate and PG&E Citygate, but it should decrease both in frequency and magnitude as SoCal load falls into the fall months. Moving into some specific outages and constraints associated with them that should be concerns as we move into the fall. One that's been pretty prevalent since last spring is Eagle Rock Gould. There is a Eagle Rock Mesa 230 kV line outage. Anytime that we see thin stack in LA or relatively high load in the LA basin, we're going to be concerned about this congestion occurring. Another one is the Imperial Valley Special Setup, the 7820 congestion here. And that's been attributable to this 230 kV special setup outage in the Imperial Valley, as well as lack of thermal generation at the coast in San Diego. So really, this outage runs through the end of October and will be a concern anytime you have that thin thermal stack in San Diego, or even high load days in San Diego can be a concern. There's also a Midway Whirlwind outage that begins for about 2 weeks on September 8th and runs through September 24th. This will be a risk for Midway-Vincent congestion really anytime you see those strong north to south flows, and that risk is exacerbated here during the time of the outage, as well as high SoCal load or high SC City Gate gas price days. We also expect a full knob derate here to begin in mid-October and run through mid to late November, so over a full month. This is a pretty common seasonal outage for the fall. Nonetheless, the concern will be for Malin 500 or Round Mountain Table Mountain congestion when those Malin flows increase during this outage. Lastly, Morro Bay Solar 230 kV line outage, driving concern for Morro Bay Solar congestion. Any strong solar days, Topaz tends to exacerbate this constraint. It is worth mentioning this outage starts in a little over a week on the 4th, runs for a couple of weeks. This outage is pending and bears watching to see if in fact the line actually does come out as we get closer. Taking a look at a map of the LA Basin and some of the transmission around it, you'll notice highlighted very busy area of transmission lines in that LA area. Some of the drivers of these east-west flows can be strong renewable generation in SoCal, periods of high SoCal load, which become less frequent as we move through the fall, a lack of renewable generation in coastal areas, and then strong Palo Verde and Victorville imports. And as mentioned a few times here, the high SoCal City Gate gas prices all can be contributing factors to east-west flows as well as east-west congestion, such as Bar Villa Park, Bar Lewis, Lugo Victorville, Devers Vista, and Eagle Rock Gould. Now taking a quick look at where monthly prices stand across the West and some of our expectations here and calls. Right now, September 15, or SP15 for September is trading at about 50.43. We like this as a slight buy, mostly because we do favor some bullish load with above normal temperatures in SP, as well as the ongoing constrained gas situation. It really wouldn't take much price strength on a couple of days to push those prices above that $50 mark. Heading into October, things become more of a hold as we start to see load trend a little bit more neutral. We do see gas playing a big factor here in the alleviation of that L3000 pipeline maintenance. So that would contribute to more import capacity on gas pipelines, lower gas, and a situation that bears close watching, as many of our expectations beyond September do hinge on the end of that L3000 event. And then for November, we're looking at a slight sell. While we are bullish on imports with that knob derate, gas is slightly bearish, and then also load with slightly warmer than normal conditions we see as a sell opportunity here. For NP, we are favoring slight buy at 38.67. Again, a lot of concerns around higher energy prices associated with the higher load in the month of September, as well as some of the upward capabilities of gas due to low generation coming in from the Northwest to California, as well as just the pipeline restrictions in SoCal. October, we're favoring more of a hold, as we do see the start of the knob derate having a bearish impact on NP, with more of those imports flowing into NorCal on Malin. Another bearish factor is going to be around congestion and some of that north-south congestion potential for strong flows on Midway-Vincent and south into SoCal. For November, we're also favoring a hold at 35.51. Again, bearish load expectations and then bearish imports really driving that hold, and then the gas situation in PG&E with inventories at some of their lowest levels in the last 5 years, driving some concern over gas prices there in NorCal. And then lastly, for Mid-C, we are favoring a slight buy at $29.75 for September. While load is bearish, we are highlighting low wind and low hydro as bullish gen signals, and then also the impact of just higher energy prices in the West due to the continued pipeline restrictions in SoCal, pulling up energy prices there. October, we start to see that shift into a slight sell at $25.25. We do think that there's going to be pretty significant impacts from that full knob derate, leading to less generation flowing into California, a little more staying internal to the Northwest. And then heading into November, more of a hold here at $25.56, with more firmly into heating degree days and heating load territory. And then also the import situation still holding for the first half of November as well, being a factor on the hold signal. So with that, I'd like to open up at this time the floor to poll question, and we're asking for feedback on which plant in the West would be most important to our customers to add to Power RT. So you'll see a poll pop up here shortly on your screen, and we'd appreciate your suggestion for Russell City, wind units or generation in Western Wyoming, Walnut Creek, or another facility that you may want to mention that's not listed here. So this will stay open through our Q&A timeframe. So please, at this time, any questions you have, submit, and we'll be happy to answer them. Thank you. So the first question that we have is asking how much import capability would open up on the gas pipelines with the end of the L3000 maintenance. And that translates to 300 MMCF increased import capacity. So another question is regarding the potential extension of the L3000 remediation event and the impact that would have on our expectations. So as a result of that potentially being extended, we would mostly anticipate NP staying at similar price levels to where we have them. The spread between NP and SP would likely widen, and as a result, we do see some upside potential more so to SP prices than NP should that outage, or the maintenance rather, be extended through the fall. All right. So with that, we'd like to wrap up our presentation. We are sharing the poll results, and it looks like the vast majority, over half of you, have requested wind in Western Wyoming. So we will take this heavily into consideration as we expand our monitoring capabilities in the West. Any other questions that we didn't have time to get to, we'll be sure and follow up on in short order. I'd like to thank you all for attending our presentation today. Remind you that there is a short survey at the end that can be filled out. Our slides and recording will be going out tomorrow. And I'd also like to thank our GAS team for their help in putting this together and the information they passed along that we were able to share with you all. So have a good day, and thank you for attending.